Hello and Happy New Year. Welcome to our first MarketCast of 2023, where we'll recap last year's highlights and share our investment strategy going forward. Last year was one of the most challenging years in the markets as we faced the triple threats of inflation, the pandemic, and the war in the Ukraine. And while we've lately seen some progress in the fight against inflation, there's now a growing concern that a recession may be coming. When we add in the uncertainty of the Ukraine war, it looks like we could be facing another volatile year in the markets with the potential for some big ups and downs. So we think that during these periods of volatility, diversification and rebalancing are going to be very important tools for managing risk and adding value. For long-term investors, we're seeing some good news this year, improvements in the long-term return outlook, which I will talk about a little bit later in the MarketCast. So let's get started by turning it over to Senior Investment Advisor, Matt Sampson.
Thank you, Reegan. Despite being an overall down year, investments rose in the fourth quarter. International and emerging markets led stocks higher as China eased its COVID-19 restrictions. And bonds also rose as investors anticipated lower future inflation and a possible end to Fed rate hikes. But full-year returns were mostly negative, as market values on stocks and bonds were driven lower by rising interest rates. What were the best performers for the year? Hedge funds and treasury bills. To put the year in perspective, this chart shows how 2022 stacks up against all the years going back to 1976. It sorts the years by return, going left to right from lowest to highest. We can see that on the far left, that for bonds, 2022 was the worst year on record. And for stocks, 2022 was the third worst year since 1976. It's our view that this simultaneous downturn in stocks and bonds was largely driven by the Federal Reserve's decision to rapidly raise interest rates to fight inflation. It's been a tough battle, but it looks like the Fed is beginning to make some progress in getting U.S. inflation under control. After peaking in June, the overall rate of inflation has lately been trending lower, led by moderating prices in energy and vehicles. Many of the other sectors have also been stabilizing. This downturn in inflation helped raise hope in the fourth quarter that the Federal Reserve might be able to pivot away from further rate hikes, which in turn could help the U.S. economy avoid recession. Despite the recent good news on inflation, many investors and economists think a recession is likely this year, and we agree. Based on our analysis of consumer prices, yield curve slope, purchasing manager, and unemployment data, we project a 66% chance of recession in the next 12 months. And if a recession does happen, we would expect to see rising unemployment and declines in production, income, and spending. But I think a more challenging question is this: how might stocks behave during a recession? To get a sense of that, let's take a look at what stocks have done in previous recessions. Here we have charts of 9 previous recessions. And we see that often, when a recession begins, which is at the left edge of each gray area, stocks are already in a downtrend and unemployment is starting an uptrend. Then, as the recession wears on, the stock market often hits a bottom and starts to recover around 6 months before the recession ends. On the other hand, unemployment typically doesn't peak until right around the end of the recession. So, the key message here is that stock prices tend to be a forward-looking economic indicator, which means that changes on Wall Street often happen months before there are changes on Main Street. Speaking of market indicators, here's one that we think is important when it comes to the outlook for international stocks: the US dollar exchange rate. On the right side of the top chart, we see that the US dollar has recently been rising against other major currencies. In fact, the dollar is now at its 70th percentile in valuation since 1970. This is important because a highly valued dollar tends to make US goods and services more expensive and less competitive in the global market. The table below shows that international equities have often outperformed US equities during periods following a strong US dollar. So while there's no guarantee that international stocks will outperform this year, we think the strong dollar is a reason for optimism around international stocks. And now, to provide an update on our market views and portfolio strategy, I'll hand it back to Reegan.
Thank you, Matt. When we build a portfolio, we consider both the short-term and long-term outlook. Currently, our short-term views are neutral in most areas. However, among conservative investments, we prefer cash and low duration for its superior yield and reduced interest rate risk. On the growth side of the portfolio, we favor hedge and diversifying investments for their risk reduction and diversification potential. We also think that hedge strategies could be a good source of dry powder for future equity purchases. When we step back to look at the long-term capital market outlook, last year's market activity has set up a more positive forward-looking return environment, and we want to be ready to maximize the opportunities. As painful as last year's market downturn was, this period of the market cycle is important. Rather than thinking of investments as down, we think of them as being more reasonably priced than they were a year ago, resulting in higher future long-term expected asset class returns. Due to the much higher bond yields and much lower stock valuations we are currently seeing in the market, our 10-year return expectation for a balanced portfolio is 1.8% higher than it was a year ago. Market volatility can be uncomfortable, but having a long-term perspective means that we can be ready to take advantage as the market cycle turns. We are very proud that Arnerich Massena has been named to the Forbes Top 100 RIA ranking list. We are the only firm headquartered in Oregon on the list, which spans firms across the nation. The third-party research firm that conducted the process received more than 36,000 nominations, of which just over 21,000 were invited to participate in the online survey. The process evaluated quantitative and qualitative criteria, and we believe it is the strength of our client relationships that made us stand out. It is an honor to earn this level of recognition, and we will continue to go above and beyond for our clients. You can learn more about this ranking and other industry recognition on our website. Thank you for joining us today.